Okay, guys, let's go ahead then, and I think we should be able to pick up from where we were, which is this sales mix. Okay, so what happens? We're sitting here and we have two products that we can produce, and we're trying to decide what is the appropriate mix, or do we want to just focus on one product? We have these different decisions that we need to make here, or the decision we're going to make as to which products we're going to produce, which ones we're not, or are we going to have a mix of the two, whatever. And the upfront instinct is to say, we'll take the one with the higher contribution margin, because the higher the contribution margin, the more it's going to contribute to my bottom line, my operating income, whatever. But you need to be careful with that, because what? These products take up resources, and if a product is going to take up resources, then we really want to figure out which one gives us the higher contribution margin per unit of machine hour, or whatever it is, right? Okay, so that if we're operating at capacity, we're getting the best output out of our equipment, out of our factory, whatever resources are being used to produce these products that we're trying to decide which ones to focus on. So we come over and we have our selling price, we have our variable cost, and so we look and they tell us that product A, it looks like has a little higher contribution margin. Is it A or B? Actually, what? B has a little higher contribution margin. Okay. However, it takes what? Or are they the same? Have the following. What is it? $1.50 and $2, right? So it's looking like product B, right, is getting the nod when you just look at contribution margin. But then what? They say that, however, it takes 1 hour to produce 1 unit of product A, while it takes what? 2 hours to produce product B. So product B is actually using up more resources, right? So what we want to do in this case is go ahead and figure out which gives us the higher contribution margin per machine hour. And so we have the what? We have the 2 hours for product B versus the 1 hour for product 1 gives me a higher contribution margin per machine hour for product A. So this company would focus all of its resources on what? On product A, right? Okay. Okay, good. So let's go ahead and let's take a look at this example. Product A requires 5 hours, machine hour per unit to be produced. Product B requires only 3 machine hours per unit. So we're already thinking what? Product B looks like it's going to get the nod, but let's see. Okay, we have to keep going because we need to figure out what's going on with the contribution margin. And the company productive capacity is limited to 240,000 machine hours. Product A sells for 16 and has a variable cost of 6. Product B sells for 12 and has a variable cost of 5. Okay, so assuming the company can sell as many units of either product as it produces, what should it do? And so we have down here, this is the solution, by the way, that I just added in here. The what? Contribution margin of $10 for product A, $16 sales price, variable cost is 6, $7 for product B. In an initial look there, you're thinking, well, pick the one with the higher contribution margin, but what? Look at the amount of machine hours that are going to get used for this higher contribution margin. So the contribution margin per unit is lower, so we would pick what? Pick product B. It has a higher contribution margin per unit, right? Okay, so our resources are best used that way. Okay, segment elimination. Okay, and if we're deciding to eliminate a segment, we only consider avoidable cost. Okay, avoidable costs are costs that will disappear if we get rid of that segment. That's how we're going to decide whether or not we're going to get rid of this segment. So if we get rid of the computer, if we want to decide whether or not we're going to get rid of the computer division, would the computer division manager salary be a cost we would consider? We get rid of that division, we're going to get rid of the computer manager, right? How about the CEO salary? CEO salary is going to be irrelevant to that decision because even if we get rid of the computer division, we still have the television division or whatever it is, right? And so we would still incur that CEO's cost, okay? So we're looking at this division and we're seeing that this division is losing $500, I don't know if it's a month or year or whatever it is. And so we're thinking, hey, let's go ahead and let's, well, we haven't said that yet. He's saying let's take a closer look at it, right, to see if we want to get rid of it. Okay, so we're only going to consider what? Avoidable cost here, right? So we come over and we take a look, and they've given us our revenue and the cost of goods sold. We have our gross profit here of $17,800, and then we come over and we have our operating expenses, okay, and then we have our direct expenses, our indirect, and there's that operating loss down there, right, of 500. And then we go ahead and we start grouping the costs into their avoidable versus unavoidable components. And when we do, we determine that what? That we have avoidable costs of $41,800. Meanwhile, we have unavoidable expenses of $6,500, right? So when we go ahead and we group the costs that way, our sales are what? $47,800. Meanwhile, we would only eliminate $41,800 of costs of getting rid of this segment. Should we get rid of it? Should we get rid of it? Yes? So you're going to give up those? Oh, you said no? So we're not going to give up. I thought somebody said yes. So we're not going to give up this additional sales just to eliminate cost of $41,800, right? Okay. Now sometimes people will say, well, why did you do this to begin with? Well, we typically do allocate some expenses to the different segments, but that's more of a reporting analysis where we're sitting there and seeing, hey, what's the operating profit of these different segments? Security Exchange Commission requirements tell us that we have to provide segment information, including the operating income of each segment. But we don't use that for internal analysis decisions, right? And so we would group the cost in avoidable versus unavoidable and only consider those costs that are avoidable. I've seen other literature that calls these traceable costs versus common costs. The unavoidable can be called common, and the avoidable can be called traceable. I've seen that in some literature as well. Some textbooks will describe it that way. Okay, so we're going to keep that segment, right? Okay, good. Keep or replace equipment. Now, the only problem that I have with these analysis is they ignore time value of money. They start talking about money that's going to be saved over the next 5 years, which ignores the fact that what? That we have to consider the present value of these amounts that are going to go out over future years to do a true analysis. And when we get into our next chapter, next time, we're going to talk about capital budgeting. And when we're making decisions about buying a new piece of equipment or keeping the old piece of equipment, those sorts of decisions, those longer-term decisions, we will be bringing in the time value of money as part of that consideration. Okay, so just sort of ignore time value of money right now, and then you'll say, well, how come we didn't ignore it, consider it in here when we start ignoring it next time? And the answer is we should have ignored it. We should have included it this time in this discussion. But for now, let's just look and consider that all dollars are equal. So they have the cost to buy a new machine is $100,000. Cash received to trade in the old machine is $25,000. So we're going to have this net amount of $75,000 that's coming in. Reduction in variable manufacturing costs, they tell me, are $72,000, and that's because the problem told me I'll save $18,000 a year for what? For the next 4 years. So I'm going to save on a non-present value basis. Again, I would discount these cash flows to get the correct, because $1 4 years from now is not the same as $1 today, right? Okay, so I'm going to have to wait for some of these 18,000s, and so I could be making a poor decision here, not considering time value of money. Okay, but they just went ahead and multiplied these times in 4 years, and they made a decision not to purchase this machine because it had I guess, a negative. If this was the present value, I would call this, I almost have trouble talking about this thing because this is not a very good analysis of just taking all the dollars and making them the same. This is a negative. If we were using present value, that'd be a negative net present value, and you don't take on any project that has a negative net present value. But again, they didn't discount the dollars here. We'll get into that more next time. Okay. You know, they say it'll decrease income by 3,000. What year? I mean, we're talking about 4 years where this is, I should have deleted this slide. Okay. All right. Okay. Let's take a look at setting product price. Okay. And they give us some steps here. And I think this is one area where maybe the steps are okay. I just don't like the way they do step 3. They kind of try to do step 3, and they try to do this slick move in step 3, and I'm like, okay, I'm not smart enough to understand that slick move, so I'm just going to kind of turn it into a step 4 because it just makes more sense to me that way. But let's just go ahead and let's take a look at this, and we are basically considering a cost plus method of determining the price of our product. In other words, we're going to figure out what our cost is, and we're going to then add on a profit margin, and that's going to tell us what to sell this product for. Now, this is a bit unrealistic, and the book even says that because it ignores what? If I just take whatever the product cost me and I add on a profit for that, what does that ignore? Well, we can consider the admin and the selling costs, whatever the costs are, okay, because I know I said product cost, but whatever the costs are on this, and then I add in a profit for that, right? And I say that's what I'm going to sell my product for. What does that ignore? That's very good. It ignores the competition prices. You know, sit here and let me be as, it ignores the competition's price. It ignores supply and demand, doesn't it? Okay, so I could sit here all day and I could be the most inefficient company in the business in manufacturing, and all I have to do is add a cost onto that. What we have is a defense contractor at that point, okay? Because defense contractors do what? They go ahead and they incur their costs, whatever it is, and they've already reached an agreement with the government that they will add a certain profit margin onto that, and that's what they charge for those items. Okay, call those, huh?
200 bucks for a screw for a
Well, yeah, that's what they call. Well, you know that what that got into was the way they would do their overhead allocation. Okay, and they used to do the overhead allocation as a plant wide, and that's how they ended up with, because I was on an audit one time where we were auditing Lockheed Missile and Space in Sunnyvale. And so what happens? You walk into the lunchroom and they've got guys in the chef's hats carving prime rib. Prime rib today, sir, for your lunch? Yeah, sure. I'll take a piece of prime rib. Okay, how much is that going to cost? Oh, it's only $3.20. For a piece of prime rib. Why? Because they can sit there and they can get away with that, because then they take the overhead of the cafeteria and they apply it to what? To all these cost plus jobs. They know their cost is going to be covered, and then we got a profit margin built into it, right? And so it was like, you know, great deal. I'm like, okay, I guess I'm not being very patriotic, but that prime, I should say no, give me a sandwich, right? But I went ahead and I tried some prime. But what happens? But what they started doing to alleviate some of that, it's still a problem, activity-based costing. Activity-based costing now says what? We're only going to assign costs that use up those particular activities, and we're not going to assign costs of which the activity does not contribute to the production of that unit. So that's something that the government started doing is requiring activity-based costing more for those things. But they still have problems, and they have these cost plus contracts on top of there, right? So, huh? Do you guys see it in the military? What do you see?
Oh my God, it's ridiculous. It's so bad. Yeah.
Really?
We pay so much more than the original price. Yep.
Yeah.
Yeah, it's ridiculous.
Yeah.
It's stupid. It's so stupid. And then we have to cry for money every fiscal year.
Yeah.
Yep. We have to spend $1 else we don't get the same amount for next year.
That's why the United States spends more on defense than the next 17 countries combined. I mean, who are we fighting? It's 17 more countries combined.
Oh no, it's a bigger picture. The way I see it, I mean, my own theory is that by the military spending that much money, we actually contribute to the, the marketplace. So.
Yeah, yeah. The question is how much profit is going in the pockets of
Yeah.
bigwigs along the way.
Most of them are people that have connections with the military.
Yeah.
So, but they still have to have employers and stuff. So.
Yeah, yeah. So anyway, we would have to consider even in here, even though the slide says it at the end, we're sort of ignoring that as we go through and determine the profit plus cost. So notice we go ahead and we have our total cost, our direct materials, direct labor, our plus our what? There's our selling and administrative costs. Somebody mentioned that we would need to include those. So that gives us our total cost per unit. We divide that by what? We divide that by the total number of units expected. That gives us our price per unit, right? Then we'll go ahead and we will simply add on a markup to the price of that product for our desired profit, right? Okay. So we come over, and that'll give us then the selling price per unit. So let's just go ahead and look at this example. There's our production cost, variable cost, production cost. There's our fixed cost, both production and non-production, both overhead. Fixed costs, both our overhead and our non-production. Now here we do consider fixed costs because what? We are trying to determine the appropriate sales price for this, right? Okay. So now we come over and they go ahead and they take the production cost, which are the $44, plus the non-production cost, which is the $6. And then we go ahead and pick up what? Pick up the overhead, the fixed cost, okay? And so we go ahead and then determine that the total cost of these units that we're going to produce, looking at both variable and fixed, is $700,000, okay? If we're going to produce 10,000 MP3 players, okay, we're going to produce 10,000 of those, so 700,000 divided by 10,000 is $70 per unit. That's our cost, isn't it? And we got both the variable and the fixed in there. And so then what? Then we go ahead, and the way they're doing it, I don't quite understand this mathematical maneuver they made here in the middle of it, and I finally got tired of looking at it. I said, I don't care. I'm not going to do it like them. It's $70, and then they said that they wanted what? They wanted profit on top of that, right? Okay, so if it's $70 and they wanted $200,000 profit on top of that, and they're producing how many units? 10,000 units. Okay, so 200,000 divided by the 10,000 units means they need an extra what? $20 per unit, don't they, to cover the profit? So I take that $20 plus the what? 70. They should sell this thing for $90 per unit, and if they do, then what? Then they will meet their target profit of $200,000. That's the way I like to do it. I mean, I'm sure there's some mathematician somewhere smiling at this. I don't want to bother myself with that. Okay? Okay, good. And so the appropriate price is $90. Now, they go ahead and they verify it. $90 times 900,000, cover our variable cost, cover our fixed cost. Sure enough, we've got what? 200,000 left over for profit. They're just verifying in a financial format, financial statement format. Okay. That's it. So I don't have a lot today, okay, obviously. So you want something else? That's all I got. Because if you do, I'm going to have to start singing, and you don't want that. Say again? I didn't get a chance to put the quiz question, which I've embedded into the slides, into the Word file. I will do that. The other thing I'll do when I get a little more time is I'll pick a few more questions for this chapter maybe. But as a practical matter, here's where we're at. We go through chapter 11 next time, which is capital budgeting. I anticipate we'll knock that out next time. Probably not this fast. It'll take us a little longer because I don't have a lot to say about this stuff. I don't know what else to tell you. Pick the one that gives you a bigger net income, and sit there and analyze the numbers. So that's why I don't have a whole lot to say about this chapter. Chapter 11 is a little more, I can talk to you about processes and way to do these and ways to look at these things. And so we'll have a little bit more, robust discussion about that. And then, guys, we are like way ahead of the curve in this class because that's chapter 11, and we're done at that point. And so with the chapters. And so from that point forward, we just sit there and start crunching on midterm questions. Final questions. That's where we're at. We've been ridiculously efficient in the way we've gone through this stuff, and it's unusual for any of my classes for us to go through this fast, but it is what it is. So that's it. Okay? So I will see you on Wednesday, chapter 11, and then after that, going forward for the rest of the semester, we are reviewing, and we're going to go all the way back to, chapter 6? Was it 6? Or 5? The final is not cumulative. It's just those back chapters. So we'll just start all over with those chapters going through questions now. Okay? All right, guys. That's after next week. We'll have a lecture next week. Wednesday. Wednesday on the slides. I don't have a sign-in sheet today.